Hello and welcome to the Mining Journal Gold Panel. My name's Chris Cann, Head of Mining Journal Research. With me I have Gervais Williams, the Head of Equities with Premier Miton. I've got John Mulligan, who is Head of Market Relations with the World Gold Council, and Charlie Gibson, who is Head of Equities with Edison Investment Research. Thank you very much for joining me, gentlemen. I'd just like to start by acknowledging the rise in the gold price so far this year and asking whether it met expectations or whether it's lagged behind from what you were expecting at the outset of 2019. Maybe if I could start with you, John.
Sure. I think the big picture, the big story about the gold price this year was the breakaway from a long-term oscillation between 1150 and 1350. Okay. And once it broke through that, it's now been bubbling just under 1500. And I think once it broke through that level, investors started to reappraise both the momentum behind gold and its function in relation to risk and the big macroeconomic drivers. I think it's very much a story, frankly, of how investors have perceived the US market and those big macroeconomic indicators.
Okay. I mean, I think there's been an absolutely huge change here. I think if you were to look back a year ago, actually an awful lot of investors were not expecting the gold price to rise. I think they saw huge headwinds. If you remember where we were a year ago, the US was normalizing interest rates, which were rising. There was a huge asset reduction program being driven by the Federal Reserve. The ECB was saying that it was stopping printing money, and that's where we were. So those were pretty significant headwinds. And I think what we've actually seen is we've seen a massive reappraisal, mostly during the course of this year, where the Fed has suddenly stopped its asset reduction program. In fact, it's basically put it on reverse. I mean, it'll say it hasn't, but you know, in most people's opinion, it has. If it looks like a duck and it quacks like a duck, and I think we know what we're talking about, then it probably is a duck, and that's what they're doing at the moment. Interest rates have gone from rising to falling. So I think there's been a huge change, which came about in about, what, March, I think?
Well, yeah, I mean, it started to filter through in summer. So you had the change in policy, you had the policy uncertainty factor that came in, but actually when you saw the price respond, it was basically that summer. And it was to do also, as you mentioned, with both the Fed expectations and how people perceive Fed policy, but also very unusually was that disconnect between gold, which is normally has a negative inverse relationship to the dollar, and the dollar. Both were showing strength, so you had outperformance in the US market and you had outperformance in gold. So I think it completely meant people started to reappraise where gold was going.
But I mean, I think generally speaking, I would say that gold has outperformed most people's expectations, in my opinion. I'm not saying it's done the wrong thing, but compared to where we were a year ago, you know, and they were making. I think one of the things that actually it shows is how short-term the markets have become. You know, you can no longer think in terms of a year anymore. You've got to think almost month by month. Oh, right, the Fed's changed its policy. You know, and then is it going to change its policy? You know, what's the political backdrop, for example? You know, we've got all of these things, and they can change quite quickly.
Yeah.
Gervais.
I was going to say, I mean, often, you know, gold's seen as a store of value. So often gold is resilient at times when markets are weak or asset prices are weak. So it's not just the dollar which has been strong this year, along with gold price, but actually many of risk assets, you know, equities and such like, have also been relatively strong. Again, quite unusual.
So if we can take a step back from the paper market, just looking mainly at just the underlying supply-demand fundamentals, what do they tell you about what gold's going to do, how it's going to behave out to the rest of this year, and then possibly looking as far into 2020 as you're prepared to look? And perhaps, John, if we can start again with you.
So the supply and demand picture over the last few years has been relatively stable, and we often talk about a self-correcting market. Basically, when you have duress in local economies, that drives investment demand. When you have consumer confidence, that drives jewellery demand. And that's been the case, give and take, a few blips over the last few years. What we've seen since summer is a shift in terms of consumer confidence in some of those key markets. At the same time, we've seen the return of institutional investors of scale. And I think that has shifted the supply and demand dynamics, and particularly what is driving the current price. It's very much now a macroeconomic story, an investment story, to some extent a US investment story. And I think so the big story in terms of demand is the ETF buying from professional investors and central bank buying. driven by some of those big macroeconomic concerns.
Gervais, how does that sit with you?
It's interesting, because really I think correlation is becoming more of an issue generally for all investors. The problem is that when we look back to 2018, it wasn't just that asset markets peaked out, it was actually that bonds also fell, many particularly corporate bonds. We saw at the same time property falling. Even many hedge funds actually had a pretty bad quarter at the end of last year. So it's about correlation, which is becoming much more problematic for institutions. And they look upon gold as a less correlated asset. What's been interesting, though, is this year actually, in spite of that, it's acted more like a correlated asset. So just when you expect one thing, something else happens. And so I think the reason we're seeing more institutional buying is that they're looking for something which perhaps won't go down should we have a market setback coming forward.
Yeah. So, and sorry, Charlie.
I was going to say, I think you had to be quite careful when you expect the gold price to reflect fundamentals in the way that we describe them. Copper, yes, I understand that. You can look at supply and you can look at demand and you can say one's going to be bigger than the other and the price is going to go up and the price is going to go down. That's because copper's used in things. But gold is kind of, however it's, in almost every way that it's consumed, it's an investment vehicle. Even if it's jewellery, that's, in my opinion, that's just a bar or a coin banged into a funny shape and worn to look nice. Mm-hmm. But it's still an investment. And so an awful lot of what happens in the gold market is just changing who holds those investments. So quite often, if the price goes up, what you'll see is then the recycling market will come into play. And what it's really doing is it's shuffling gold from those who hold it and perhaps don't want it so much to those who don't have it and do want it. But there are all of these things in gold which, if you like, sort of auto-correct, which I think is why it's a less correlated asset, because it's not consumed in the same way. You know, even if it's at the bottom of the sea, that's about the only time it's consumed, is if it's in a ship and the ship goes to the bottom of the sea. But otherwise, it's not consumed in the way that other metals are.
I don't have quite the same perception of consumption as Charlie. I think I agree entirely that the diversity of demand is absolutely key to gold, and that's what makes it an uncorrelated asset. There is no more diverse metal, certainly no more diverse commodity than gold. Basically, it's a long way, the motivations for buying gold, it's a long way from the Polish central banker to the Indian housewife, and they're both substantial buyers. And I think that diversity means that it's not driven by one particular factor or one particular market condition. So one of the things we haven't mentioned, I think, is the low interest rate, low yield environment. And if you look at certainly from an institutional point of view, a pension fund or a big institution looking for stable returns, the negative interest rate environment is quite extreme. You know, I think it's 70 to 80% of sovereign bonds are now negative in real terms. So that means a huge pool of assets that previously were depended upon to give you stable returns, you know, fixed income. It's something you could depend upon in your assets, in your investment strategy. I think that's currently, you know, you're paying for the honour of holding that asset. And I think that actually drives certainly investor strategies over the long term. I think I agree again, over the short term, fundamentals actually don't immediately translate into the price. And the immediate price drivers are those things we mentioned earlier, the short-term macroeconomic factors.
And I would absolutely go along with that. I mean, something I think is very interesting is that if you look at the 1970s and compare it with the period 2007 to present, now one is a little bit longer than the other, but the pattern of real interest rates in the United States is almost identical. And in both periods, you start with positive real interest rates and the US running twin deficits. The Fed is raising interest rates. That pops an internal bubble. The Dow halves. The Fed crash interest rates down and real rates go absolutely negative. That you then have this attempted period of normalization. And it's almost identical for both periods. And then you get to the point where suddenly the Fed says, oh, we can't normalize anymore. There's a real problem. And that was the late 1970s. And, you know, it's correlating to the period. And that correlated last time with a period of quite a lot of volatility in lots of assets. But one of the things that I notice is that the gold price didn't peak out until real interest rates were something like 4%.
Okay.
And, you know, we're nowhere near that point at the moment. But I think it's that if you want to try and forecast where the gold price is going, I think it's those things that you want to look at rather than the supply and demand. I know that, you know, supply and demand is...
I think it depends on your time horizons.
Yes.
And I think, so you mentioned this quarter and the next quarter, and I think you're absolutely right. And there's you can map interest rates and gold quite closely at the moment, and I think it's a key driver. If, however, you ask the question, and I think from a mining space or mining investor space, in the mining investor space, you need to look beyond that short term. And I think that short-termism you mentioned is a problem for some of these discussions, because actually it doesn't answer the question, why is the scale of the gold market double to what it was 3 decades ago, and why is its value quadrupled? That is a story that's to do with fundamentals. It's to do with that growth in income and wealth in the developing economies that are the key physical markets. And I think, so looking beyond the next quarter to the next year or two, I think you need to look at fundamentals.
Gervais?
I was going to say, I mean, one of the interesting things about gold, of course, is that it doesn't have a yield. And that's a fundamental disadvantage to holding gold. Of course, what's interesting between now and the 70s, of course, is that absolute yields are very, very low. So actually, when yields go to negative levels, then effectively, in a way, gold has more of a yield than the market itself. Very unusual. Yeah. And again, I think driving interest in the sector. So I think that's one of the key features, was why institutions around the world are actually giving a greater interest to gold. I mean, coming back to your point, John, about why has the sector grown? I think actually the last 3 decades have been driven by globalization of world trade. Specifically, we've had a surge of low-cost goods in terms of, you know, consumer goods coming into all sorts of countries around the world, which has led to deflation of imports, inflation of local costs because of extra growth. But the net effect has been that actually overall interest rates across all of the economies of the world have reduced, and they've reduced and reduced. Since 2008, we've had further reductions of quantitative easing. So we've got to a stage now where actually assets prices are very inflated, valuations are very inflated. And going forward, we've got to be worried that actually if world growth does slow beyond globalization, more nationalism, then effectively we're actually entering a period of slow growth. And we could be entering a period when actually asset prices are more volatile, and we do actually see setbacks to not just equity markets, but other asset prices as well. So I think gold could be a store of value in an uncertain world, and I think that's becoming more and more important for institutions generally.
And I think one of the things that follows on from that is that I think that's what drives the central banks as well. Yes. You know, if you imagine you were the People's Bank of China and you've got this huge stack of dollars, and half of them or a lot of them are yielding negatively, you think, well, how do I diversify my way out of this? Well, one of the obvious routes is gold. So it's not a surprise to me that at a time of negative real interest rates, you're also seeing the central banks buying.
Yeah.
So if I can put maybe Gervais and Charlie on the spot, I know you'll have your internal forecast. What are you looking at for gold out to the end of 2020?
Well, I think you have to set it in the context of wider markets. We probably think that markets themselves are probably running out of steam at the moment, so we don't expect a lot of forward progress. Whether they have a setback is harder to choose, but ultimately we do to perceive that actually gold will get through the $1,500 mark and will continue to rise. I don't think it'll get that far, maybe 1,600, 1,650, but I think it's on the rising trend at the moment.
We would agree with that. I mean, I think 1672 is our figure, okay. which is you know
specific.
Specific. You know, I think from the perspective of now, looks quite brave. But if you look at where people's forecasts were 3 years ago for this year, they were nowhere near as high as the prices actually have been. So we're going to stick with our forecast until we're definitively proved otherwise.
Okay. And looking at people who share the view that gold is most likely going to continue moving higher, how are investors consuming gold at the moment when you consider the various ways you have to consume gold, from the physical through to ETFs, etc.? What's your take on the trends in terms of consumption? And maybe that's another one for
well, I'd
John
certainly kick it off, yeah. Well, I mentioned earlier that the big story has been ETF buying. The physical gold ETFs in Q3, like I say, 260 odd tons or so, is quite remarkable. What's key, if you look at that, the composition of those ETF buyers, for a while we saw the Europeans actually being the stable buyers, and from 2015 or 2016, should I say, US ETF buying was somewhat tepid. They have now come back into the market, and I think it's for the reasons we've talked about. The European buying is fairly stable. This quarter, in fact this month, it has returned with some force. There's been some risk fatigue, I think, with the European investors in some ways. So I think the ETF story is the strongest. Physical bar and coin buying, which is the private investor or private wealth aspect of gold buying, and people don't realize how substantial that can be in key markets. That has been a little weak. I would expect investor reappraisal, private investor reappraisal, to actually strengthen that in the next half of a year or so. And then when it comes to the big buyers in terms of the long-term picture, 70% or so of gold is still bar and coin or jewelry. Jewelry is still half of the whole market. I think that's largely dependent on consumer confidence, confidence in discretionary spending over the next year or two. That's key to what drives the jewelry markets. But the jewelry markets, as we say, are very diverse. So the Indian market is driven by seasonality. It's driven by auspicious days, festivals. And that's very key. The number of key days in which you should give gold or when you should get married. Some years have a lot more than others, and that's quite an important factor. And then monsoons. So there's a whole lot of things in specific markets that you have to look to going forward. But I think the fact that this is normally a self-correcting market, a relatively balanced market, over the longer term, I think we're reasonably confident in that because it's all to do with economic growth and wealth over the long term.
I think there's other trends too. I think we've seen the general increase in passive investment strategies. So ETFs, physical gold, of course, is a big area of growth, but actually just buying into an ETF, which is gold mining companies, is equally positive and also been a very significant trend. And this is, if anything, squeezed capital availability for some of the smaller quoted companies. They found it a little harder, being that they're not part of the ETFs, to actually participate. And if anything, we've seen a setback perhaps in some of the less liquid stocks in London, which actually haven't had the access to markets, not just because they're gold companies, but just because they're small gold companies. And I think both those factors have actually made it a little harder in spite of the rise of gold price this year.
And I think that's a very interesting point, because something that we've noticed is that two things. First of all, if you look at equities compared to gold, if you look over the long term, actually gold metal outperforms an awful lot of equities. But just in in 2019 so far, something you've seen is the gold price has gone up, and then the big gold producers have gone up about 50% probably. A lot of the juniors haven't moved at all, and actually the biggest gains have been in the small to medium-sized producers, and they might be up 4 times. They might be up by multiples. And in the past, I think everyone would have said, look, the juniors, the explorers are the most geared to the gold price. They would have gone up the most. Then you'd have had the medium-sized. It's not exactly the reverse of what it used to be, but there's a definite change in the pattern of short-term equity movements relative to short-term gold price movement.
That's absolutely right. And actually what's interesting is there are some companies which are existing gold producers where the share prices have moved quite nicely. And of course the advantage of buying a gold mining company, particularly an existing producer, is that they generate good and growing income. And income is becoming more important, as we know, for all investors. You can get some very good yields on the gold companies, and some of those with income have done very well.
So I wanted to ask questions both about equity pricing and about consolidation in the sector, and it feels like these things are very much related. If people aren't investing in the smaller quoted companies, which generally are the exploration drivers for the pipeline for gold production, do we necessarily have to see consolidation, which we've already seen starting at the top and moving into the mid-tier, mainly in West Africa? Do we have to see the junior sector being consolidated to ensure that there will be a pipeline to push supply through for the gold market?
You often see large companies consolidating to reduce costs. Has happened this year again with Newmont and others. So that's been a feature up to now. I think actually in terms of smaller quoted companies, I mean, you can get big companies buying assets because they want to get into the assets. It's a sort of immature asset which is coming into maturity, and that's certainly driving it. But I don't think we're seeing a lot of consolidation at the bottom end at the moment. And that's because if you've got a certain amount of costs, you don't really want to double those costs if you've got you don't want 2 immature assets. So from that point of view, we haven't seen much in the way of mergers at the bottom end of the market.
No, I think the point I was trying to get at was, do we have to? Do we need to see that? Because obviously larger companies traditionally not particularly good at exploration. Obviously that's not a rule, but the explorers are usually the smaller companies and the more entrepreneurial companies. They're the ones who often drive the next major discoveries, and then they're consolidated in time. If we're not seeing investment into these smaller companies, Charlie, as you were saying, if we're not seeing junior stocks rising and being able to fund that exploration, do we need consolidation to make sure that we are starting to see a pipeline of new projects entering the market for physical supply? I
think something's got to give, because otherwise we've got the situation where the juniors are doing their exploration, they're even doing bankable feasibility studies, but then trying to go the last step and actually raise the finance, that's the bit that's proving the problem, I think. And I think it's still very, very difficult, or it is very, very difficult for them to raise money. So, you know, and there are question marks about are the stock markets broken, because that's the role that they're supposed to fulfill, but they don't seem to be fulfilling it at the moment. But if that's not going to happen, something has to happen. And, you know, it probably does need to be some form of consolidation somehow, or alternatively, the juniors had to find an alternative form of funding. And there are increasingly, I think, alternative forms of funding out there that they might be able to use. But something's got to happen, because we can't remain in this situation where there's no consolidation and the juniors can't get their projects financed. It's got to go one of two ways, I think.
Probably specifically for Gervais, in your position, is the other issue that the quality of assets that larger companies might like to acquire isn't quite what it used to be, or are the standards higher in terms of, or the threshold for M&A? Are there investment grade assets to pick up in the junior space?
Absolutely. I would certainly reinforce that point, because actually what's actually happened is many of these smaller companies have actually been developing the assets over recent years. The rising gold price has been a good background for them. It's made it easier for them to justify very attractive returns. And so you actually are seeing more interest in those assets, albeit that they've not actually led to deals so far.
Okay. So would we expect to see a few deals then coming through in terms of M&A? If the assets are there, if valuations are down, but with the rising gold price, we're assuming that the balance sheets of larger gold miners are looking increasingly healthy. Should we be expecting 2020 to be a year of consolidation?
I think so, yeah.
I think a little bit. I'm afraid I think that the larger gold companies aren't that brave. And I'm not sure they're brave enough to buy exploration assets wholesale. So I think what's going to happen is you're going to see a little bit more of what they've done so far, which is the big companies get together. There's only so far that'll go because there are not that many big companies. Then I think that the small and medium-sized explorers will become attractive, because the big companies, when they buy it, they know what they're buying and they know the cash flow they're buying, and they can put a number to that. It may take a while longer. I think it will come, but I think it may take a while longer before you see the majors start to buy junior assets, junior exploration assets.
Do we need a sense of desperation in that market? I know when last time we saw consolidation, there was a lot of talk around reserves dropping to critical lows, and we saw consolidation then. Do we need to get to a point where there is a bit more desperation in the market to see that?
Well, I think we can say we're not there now. So assuming that desperation is increasing, then yes, I'm not quite sure that I wish I could pick that point off a graph and say, that's where it's going to happen. But yeah, I think it will happen. It's how long in time is that piece of string.
Okay.
Mixing my metaphors.
There is still a question, I think, around that big question of the strategic replacement of reserves, and I think how that is done, because you mentioned buying exploration, but I think you need to. We know that basically exploration budgets don't translate into discovery, and I think the question there is, okay, over the long term, over the next 10 to 15 years, how do those big companies replace those strategic reserves? And I think some of that is likely to lead to some degree of M&A activity.
Taking a step just slightly sideways into silver, obviously appreciating alongside gold. Why would investors look at silver as opposed to a gold investment? What's driving the silver price that's different, and why would you make that choice as opposed to the number of different ways you could buy gold?
Well, I would say that, you say silver rising with gold, and I would say yes, sort of, but if you look at the gold-silver ratio, it's right out in an extreme at the moment. It's close to 90. It started, 100 and a bit years ago at something like 20. And then I would have said the general pattern is, at times of economic stability and growth, silver outperforms, and at times of crisis and monetary expansion, that's when gold outperforms. Now, I think that's why we're probably out at, the ratio being something like 90 times, or certainly upper 80s. I think what we've got to see is a tip over, which I don't think we're at yet, towards stable economic growth in the Western world, because my take on it is in my opinion, gold is a monetary asset, and silver is sort of a 50-50, somewhat monetary and somewhat industrial. Certainly the applications of silver There are many more applications that are industrially based. So, and I think that's the thing that needs to be driven, is consumption of that silver, into electronics, into medical, into all those areas where silver consumption is growing, actually, because for years it used to be about photography and about tableware, really, photography and jewellery, and those were going nowhere. But now we have these new applications. I do think we need to see the economies in the Western world, I suppose, in the whole world, just move on from where they are at the moment.
Okay.
I mean, I've always felt, that silver is a bit like a Cinderella. It's been, overlooked for many years. I think there has been a fundamental change in industrial usage, as Charlie mentioned, specifically in photography and tableware, and both those factors have actually worked against it. I think as an investor, though, it is actually quite a tangible asset. It has a lot of the advantages of gold, of being very physical and a store of value. And so actually, from the point of view of looking at companies, mining companies, I think some of the silver mining companies are looking quite interesting. They're not as well researched as some of the gold companies, and they're often, there may be more recovery potential in silver now compared with the gold price, and so you might actually make more money on some of those particular investments.
Okay. It's certainly true that silver is very cheap at the moment. If you look at that ratio, where is it since 1971 when it's averaged 57? Isaac Newton, I think it was, calculated there was 20 times as much silver in the Earth's crust than there was gold, and therefore he said the ratio should be about 20 to 1, possibly 40 to 1 if you look at the number of atoms rather than the weight of those atoms. But, you're sort of looking around there. You're not looking at 90.
Okay, yeah.
I obviously work for the World Gold Council, so I've got a very clear view on this. From my point of view, when we look at investment and the case for gold, the investment case for gold, basically we look at a number of factors. Silver doesn't have the same robust story. Basically, yes, gold is a military asset, but it's also a consumer good, it's also a luxury good, it's also actually an industrial metal. A lot of the things that people focus on that have driven silver in the recent period, the movement to photovoltaics, have been very important. But some of those technologies are also key to driving gold's uses. Admittedly, it's only 10% or so of demand, but it will be meaningful going forward in terms of how people perceive gold. It isn't just a kind of dead monetary metal, to use a phrase. I know.
Monetary metals are not dead.
I know, but I mean, it isn't purely, it has utility, that's what I mean.
Yeah.
That said, I think the big thing for me with silver is if you look at an asset in terms of long-term portfolio modelling, silver's just too volatile. And I think the drivers just aren't the same to actually make the case. I think there's lots of case for silver mining companies and particular investment cases specifically. But if you're talking about the metal as a strategic asset, I just think it hasn't got the same robust story.
Okay.
I'm more upbeat. I'm not saying it's going to outperform gold. I don't know if it will or won't. But again, as an investor, a less correlated asset is always nice. A bit of extra volatility, whilst it can be obviously worrying at the time, ultimately that improves the expected return. So ultimately, I think actually silver is quite an interesting asset.
Are there certain equities that you're looking at the moment that you'd like to share with anyone that you think are...
No, actually, I don't hold any silver equities.
Okay.
There aren't many listed in London.
Are you going to?
Well, Fresnillo is the only one I really know of, and for various reasons, we're not holding that one at the moment.
Okay. Again, moving slightly to the side, cryptocurrencies, Bitcoin, etc. We have to touch on it. It felt like it was a rising story probably 18 months ago, 2 years. Feels a bit, at least from my position, like it's gone away. Are we still seeing demand for cryptocurrencies pinching some of that demand for gold that we might see? And what's the outlook from your perspectives on the cryptocurrency story as an investment in relation to gold and other markets, to be honest? Maybe John, again, it's probably you've got a strong opinion on this.
A particularly strong opinion on this. You're right, it's the question that we were asked most, certainly last year or the year before, the last few years. It's been dominating a lot of commentary. And a lot of that has been noise, frankly. For me, gold and cryptocurrency, and I would say crypto assets, because I still bulk at the phrase cryptocurrency, but crypto assets, I think they're completely different sorts of assets. And I think some of the people who might be looking for short-term, speculative, high-return assets, people perhaps looking in the junior mining space, they may be interested in something like gold, and I think we could also throw in cannabis as well, where you've had a lot of that, a lot of attention and a lot of competition in very specific markets. So yes, speculative investors, investors in the Toronto Stock Exchange. There's been competitive demand there. But I think in terms of gold as an asset, bullion-backed assets, and the case for gold compared to the case for crypto, I don't think there's any comparison. And I don't think crypto performs as that store of value that you mentioned. I don't think it actually has an underlying compelling fundamental story. And I think they're not comparable.
I mean, it's a novel asset class. At this stage, it's still in the early stages. It goes up and down. I think it's still valued at several £billion, so let's not just completely ignore it entirely. There is quite a lot of capital in there. And what's been interesting about the crypto market is how many new cryptocurrencies have been developed over recent years. So in contrast to other assets, you can have as many cryptocurrencies as you want in a long-term basis, which obviously undermines the long-term attractions of the asset class as a whole. You can manufacture it on paper very easily. So actually there are some principal assets though, some bitcoins and others, which actually are the principal currencies in this area, which actually probably are more long lasting. I think we'll really know whether they're a proper asset long term once they've been through a bear market and we've had a really difficult phase. After that, we'll then know whether there is a store of value or there isn't. At this stage, we just don't know.
I mean, I think what you say is absolutely true, and it completely undermines cryptocurrencies, in my opinion. I mean, as I recall, Bitcoin, when it was set up, it was supposed to be a store of value. It was supposed to be stable and to protect you against the depredations, particularly of the Federal Reserve and money printing on the US dollar. So it was supposed to be something that was stable, not something that's flying around all over the place. And the other thing is that the one statistic I know about cryptocurrencies is there are more cryptocurrencies in the world than there are currencies. And that's nonsense. I mean, it's got to be nonsense. And do I think there's room in the world for, I don't know, I'm going to pick a number, 4 cryptocurrencies that are supposed to protect you against the depredations of fiat money? Yeah, I understand that completely. But the idea that there are several hundreds of them and they're all performing this role is rubbish. So I think there needs to be, as much as there needs to be consolidation in the mining space, I think there needs to be a lot more actually in the cryptocurrency space. Yeah. It's a ledger, for heaven's sake. You just need to know who's got it on one side and who confirms it, who's got it on the other side. It's not rocket science.
And I think it will be a regulatory-driven market too for a while because the motivations that drove investors towards crypto are still now being looked at by the regulators and the central banks. And I think so it will be a regulatory-driven market, which, depending on where you sit, I think makes it a muddied water in terms of the investment story.
Okay. I also wanted to look at sustainable investing, specifically to gold, but also in the broader market. It's been something that has, again, been rising, been a trend that we're seeing in the metals and mining sector. I think it's a lot more sustainable, appropriately, than cryptocurrencies. Just very interested to hear your perspectives and the way you're seeing this trend develop, and specifically how mining companies and mining investors sit in developing these themes and being sustainable businesses. Maybe, Gervais, if we can start with you on that one.
Yes, I think this is a trend which has been with us for some time. We've had governance in London as a key issue, which has really been there for over 20 years. The London market is very well developed in the governance area. Of course, what you're talking about is environmental issues, sustainability issues, which have become much more important in recent years, and particularly not just with investors, but actually also with clients. Clients are becoming very interested in sustainability issues. It's becoming a dominant theme. It's becoming an important theme. And when you look at mining companies, what's interesting about them is that actually they've been dealing with some of these issues for years. And we're not just talking about accident rates and health and safety, which have obviously been an important consideration of risk and maximising the opportunity of generating a return. But also there's been other issues to do with actually operating in countries which are often not always easy to deal with. You've got to deal with the local community. You've got to continue to retain support. You've got to engage with the local community in terms of building schools and such like. Again, mining companies are well developed in this area. But more recently, what's been interesting is we're actually getting some really interesting innovation from some of the mining companies, the gold mining companies. So if you take Newmont, for example, they've just introduced their bonus scheme for all of their executives. They're including, as part of that component, sustainability as one of the components. I don't know of another PLC which is doing that at the moment. So it's only 5% at this stage, but it's quite interesting that they're right at the front end of this curve. And that's very interesting because if it's becoming more important, it's great that this industry is actually so well placed to participate.
I think John actually has written the definitive paper on this.
Well, I don't. Thank you, Charlie. We recently launched something called the Responsible Gold Mining Principles, and it was, and they've been worked on for several years. They are, if you like, a consolidation, a crystallization of some of those trends. They were, to some extent, a response to investor demands. So when we talk to big institutional investors, increasingly they've been saying, okay, you can talk about the investment case for gold, but first talk about ESG credentials. Tell us where gold sits on the spectrum of sustainability risks and the drivers that will move the industry forward in terms of sustainability. So responsible gold mining principles, very quickly, 10 principles, 51 detailed principles. What we're asking for is the companies to commit to them and then to demonstrate them, to actually report on them. A lot of them are independently audited, so in the next 2 to 3 years, we hope that set of principles will actually start to demonstrate some of the trends that we've seen gold mining companies already exhibit, but actually in a kind of more coherent, comprehensive fashion. And I think, we've covered the whole ESG spectrum, like I say, the 51 detailed principles, environmental, social, governance. I think if the industry embraces those principles, I think that means that we'll not only be seen to respond to this relatively long-term trend in the case of investment demand, but actually will be ahead of the curve. And I think the opportunity for gold mining to particular to show leadership is kind of, we're at that tipping point now. And I think it's something that will drive the industry forward, I hope.
I mean, it's interesting. We had results recently from a company called Petropavlovsk. It's a Russian company listed in London. And in their top 5 credentials, in terms of the profits and such like, they also included the amount of CO2 they produce per ounce of gold. What an innovative and interesting feature to include.
So we just, after we launched the Responsible Gold Mining Principles, we launched something called Gold and Climate Change, the second report we've done on that. And so that's something very close to my heart. And we're expecting, frankly, most companies across the board, not specific to gold mining or mining.
I wholly agree. I think this will become a much more standard reporting mechanism.
Yeah, exactly. And it will become a responsibility just of general reporting, for company reporting. And I think, investors are starting to expect that. If you look at the Climate Action 100 Plus or the Principles of Responsible Investing, these big investment clusters, you're talking about $30 or $40 trillion worth of investment, they're now making demands of all corporate entities. And so I think gold mining can be, if you like, show leadership on this.
And I very much hope that it does, because one of the features, I think, and I broaden it a little bit from gold mining to the mining industry generally, is I know a few industries where the reality of how the industry operates and the public perception are so far apart. And actually, most of the mining industry is incredibly modern, very innovative, very efficient, and very environmentally aware. To sort of paraphrase Stelios Hagianou of EasyJet, if you think safety's expensive, then try having an accident. And, most mining industries are desperate to avoid accidents. I'm not saying they don't happen, but they're desperate. But the public has this perception of, of the mining industry as being sort of dark, satanic pits from the 19th century with grimy men, poor, impoverished, put upon men going down with their pickaxe and their light on their head and, sort of chipping away. And the difference between the two could not be further apart. And I hope this is a colossal opportunity, not just for the gold mining industry, but for the mining industry generally, to say, actually, look, this is what the industry does, and this is what it builds. The entire environment around us is built from mining, or in some cases it's grown, or it's in the form of wood, but basically our entire environment is a mined environment, or is the product of a mined environment. And I think it's time the industry stood up and said, look, this is what we do, and this is how we do it, and this is why we do it, by the way, as well. And these are the values that we bring to that when we do it, by the way, because if you compare how the mining industry mines to how artisanal miners mine, I mean, now that is something that's really properly dirty. In the mining industry, the gold mining industry often takes a lot of flack, I suppose, because it uses cyanide, because it has to. If you look at what the artisanals do, I mean, they're grinding it up, they're mixing mercury, for heaven's sake, to extract the gold, and then they boil off the mercury into the atmosphere. I mean, from an environmental perspective, it's a catastrophe. And that's actually, something that needs to be addressed. But, I think this is a great opportunity for the mining industry generally.
We are seeing, from a mining journal perspective, speaking to executives and investors around the world, we are definitely seeing a huge push in this direction, and I agree with Gervais. It's largely gold companies that are leading it. You can add Polymetal in there as well, doing some fantastic work. Again, Russian. I think what we'd find interesting is are investors starting to come to the party. There's a lot of stick, to put it in that term, over the past several years around the performance and the safety standards and environmental standards of the mining industry, and I think the mining industry has come a long way. Are investors starting to reward the mining industry for that, or is that to come, or is that wishful thinking?
I think that's still to come. I mean, there are some other larger companies which have performed very well, and people do recognise how much they've done in these areas. So I think there is recognition in terms of share valuations. Of course, that's in comparison with all sorts of other companies. But of course, what we believe is actually by embracing in this journey, not only they're ahead of the curve, but actually they'll get more support in time. And particularly if we find that actually other asset prices peak out, as they did at the end of 2018 again, then one assumes that these factors will come to the top, and you'll see the value of them coming through at a time when other companies are suffering more difficult times.
I mean, something I've noticed is that 20 years ago, the South African companies, the mining houses, always used to start their presentations with their safety statistics. And they needed to because they were pretty grim at the time, and they're a lot better now. But now I notice a lot more non-South African companies are starting their investor presentations with their safety statistics. And I think it shows how it's moving up the grid in terms of investor awareness and the importance that's attached to it as well.
Yeah, I think gold mining companies haven't been, or mining companies generally, but gold mining companies haven't been the best tellers of their own story. And I think, so communicating the positive impacts, the socioeconomic impacts, the catalysts that gold mining can bring to an economy, I think needs to be done better, more coherently. This isn't I don't think is the kind of CSR bolt-on that we had 5 or 10 years ago. I think this is now central, and from our perspective, this is absolutely investor-driven. I mean, the World Gold Council started prioritising this because of investor pressure. When we're taking gold to investors, they're saying to us, what is the story? And that story has to be coherent all the way from market, all the way back to the mine. So I think for us, this is an investment story.
I wholly agree. I think the mining industry hasn't told its story as well as it could. And I think actually coming back to annual reports, I think a lot of companies should actually put a lot more emphasis into not showing just the kind of smiling faces of people involved in the mining, but actually a lot more of these tangible aspects, how they've changed, how they're monitoring going forward. Yeah. There's a really good story to be told here. And I think presentations, again, they might talk about health and safety and accident rates, but they don't talk anything like enough, not just about the issues to do with environmental, but some of the positive aspects they're making in terms of impact to the local communities.
Gervais, specifically for yourself, market liquidity has been an issue, a growing issue, another growing issue. In the case of an economic crisis happening, which many are predicting for next year, what are we expecting from liquidity, assuming it's going to drop in markets in general, and how are we expecting gold to play out in that context? And does it make it more or less attractive in your view?
I mean, it's interesting. If we look back over the last 10 years, we have seen a decline in market liquidity in all sorts of areas. And those participants in markets have actually become more and more correlated. More and more ETFs doing more and more the same thing, more index funds doing the same thing. So there's a replication, a correlation of transactions and behaviour, which is becoming more problematic should we get to the next downturn. We don't know whether the next downturn is next year or beyond. It'll come when it comes. But when it does come, what we're worried about is you may see not just asset markets coming down, particularly some of the corporate bond markets may freeze up. We see it really quite difficult to re-liquefy those assets in the way that we did in 2008. If you remember in the UK in 2008, we cut interest rates from 5 3/4 to 0.5%. US also had emergency cuts of interest rates as well. We actually were introduced in QE, quantitative easing, for the first time. All that shock and awe was, came in and helped re-liquefy markets. Going forward, it may be when we get the next downturn, we get a logjam in certain asset classes, and actually it's really difficult to re-liquefy markets. coming back to gold, the great advantage of gold is that it's an asset which actually has tangible value as a store of value in its own right. At times when things are tough, you might want to buy more gold, not less. And therefore, as an asset market, it may well be actually more liquid than most of the other markets. And it's that feature, I think, which could become a lot more important, not just for gold itself, not just for gold ETFs and such like, but particularly also for gold mining companies and the ability of gold price, the share prices of companies to actually continue to rise. So coming back to that feature, you know, what fund manager wouldn't want more assets which become more liquid potentially at a time of crisis in the future? It's a key area for investors going forward.
Yeah.
John?
I just add that I think people often underestimate the depth and liquidity in the gold market itself. And so I think it's often seen as a small market, but it's actually a lot more deep and liquid market than people expect or understand. And I think that itself means in times of duress, the troubles you talk about, I think gold actually, you know, has that liquidity. So both as a store of value and as a deep and liquid market, there are strengths there.
I think that's absolutely right. I mean, isn't it fascinating that we've seen this logjam already in the last couple of months in the US, you know, the short-end bond market, or the bill market, and the Federal Reserve reacting to that by, pumping in another 60 billion a month. So we've already seen, I think, the first signs of this. And Gervais is absolutely right. I mean, last time we had a real problem, there were two levers to pull. There was the interest rate lever and there was the monetization lever. Now we don't have the interest lever. We've only got the monetization lever. So, he's also right that a downturn will come at some point. What are we left with? We're left with monetization. So I think we're going to see monetization of debt, because that's the only thing that authorities will be able to do in order to try and solve the problem. And that's hugely supportive for gold.
Charlie, thank you very much. John, Gervais, thank you very much for your time. Thank you for watching.
Cheers.